Everyone, today is Friday, June 12th, 2020. The market's still in session. This morning, the future opened up higher and then it came down pretty hard. But now it found a support at 2900 level. I think anything below 3000 is pretty safe spot to enter this market. I don't think you're gonna lose in the next week or so if you enter below 3000. So I did enter quite a bit in my. I did buy quite a bit S&P 500 futures around this area just now, and we'll wait and see. If this thing dips lower, I'm gonna buy more. I don't think it's gonna go below 2940 ish because there's looks to me we have a kind of a this area is a excuse me. Buy area, and we have a lot of money here. So if the market does dip, to 2900s, I'll buy more. I'll buy more of these. Okay, so let's take a look at other stuff. Today, this video, I just want to talk about the state of monetary supply, or I'm going to talk a little bit on the macroeconomic situation in the current cycle, right? Like we're in right now, so that we can have a better understanding of what the market is potentially likely to go in the future. So let's take a look. So one thing is the yield curve. The yield curve usually, when it goes inverted, it usually happens before a recession. You can see that the yield curve got inverted. Last time got inverted in August, starting March 2019, but inverting in August 2019 reached bottom. Now it came back. So it seems that every time the yield curve kind of reverses, the recession is almost over. You can see that. So when the yield curve hits the bottom, after that we have a recession, but then it reverses. The recession could be coming to an end, or we're coming out of the recession. Let's look at the industrial production index. Also the same story as you. I mean, I don't have to really look at the index to know that the industrial production is down, and we are down right now. But that's usually the case when we're in a recession, and we are quite drastically in the industrial production index, similar to at a similar level as 2009. Capacity utilization, that's interesting to look at. Manufacturing capacity, how much is what's the percentage of that is being utilized. It seems that right now the manufacturing capacity is being utilized pretty well. Like at least in terms of capacity utilization, the impact is not as much as the 2009 2008 credit bubble burst. So that's a very good sign for the economy. We also have the U.S. high yield index option adjusted spread. You can see that when the spread is very high, it means there's a lack of liquidity in the market. So in the March we have a very the spread just kind of spiked, and that we had a sudden lack of liquidity in the market. That's why all the market start free falling, the stock market, the bond market, all that stuff, right? Everyone's rushing to cash because the lack of liquidity. But then the Fed came in, started printing money, so this thing has been compressed. So this is very. I don't think this is going to turn up like something like this. We're gonna have another spike. The reason is this time the Fed is ahead of the curve. In November 2008, this area, the Fed was not taking as aggressive action as what we're having right now. So I don't think that this could be turned out like this. It's very unlikely because the Fed is being very preemptive, and they have promised the market they're gonna print whatever they can in order to support the market, right? That's the promise, and they're gonna do that. They're going to print as much as they possibly can. They're going to buy any of the bond that is in the market. They can basically buy everything. So I don't think we're going to potentially have another huge liquidity events in this downturn, because the Fed is expecting it. So they are going to buy anything whenever the liquidity dries out. Okay, so let's look at the M2 money stock, which is a measure of the money supply in in the economy. And you can see that the money supply has been going quite linearly until recently. Obviously the Fed started printing so much money, it just go completely vertical, and we all know about that. This is a percent change in M2 money. In the previous chart, you can see that we have a very since Q4 2018, the money supply actually has been expanding, and this change is continuing going up, right? This is a very interesting chart talking about the velocity of M2 money stock. So despite the M2 has been expanding aggressively, the Fed is expanding aggressively the M2, the velocity of the M2 money stock has been declining since 1997. So this just tells you that the reason the money in the economy are not being exchanged from one person to another per unit of money supply, right? So it just shows that this economy, the Federal Reserve has a limitation of stimulating the economy because the velocity of money is very low. So even though the economy is awash with liquidity right now, people are not willing to spend that money, right? People just put the money into an asset class and try to have a yield out of that investment, but the money is not being spent in the real economy. It's not being changed hands. It's not being put into buying goods and services, as much as just being kind of a stayed at one spot and trying to one asset class, like putting in real estate or putting in the stock market, try to achieve a certain percentage return. So in this economy, obviously, because the velocity of money is very low, so the real inflation cannot be possibly achieved by just printing out more money, right? We have asset price inflation, but in terms of commodity price inflation or inflation in real goods and services is actually very difficult to achieve. The reason is we've been having a declining velocity of money since 1998, and this is a long-term cyclical trend, a long-term cycle trend. So we are at, according to Ray Dalio, if you guys watch the video, we are the Fed is having trouble stimulating the economy because of the low velocity of money, and he called this effect pushing on the string, right? So let's take a look at this. Another chart, the M2 over the monetary base. So you can see that in 2008, sorry, I'm blocking this. In 2008, this is basically the money multiplier. The money multiplier is basically a feature of fractional reserve banking, and if you have a very low money multiplier, for example, is an indication of the amount of money being lent out by the banks. I think that's how you can put it. Like how is like the Federal Reserve prints out money, and are these money being lent out as loans into the economy, so it can stimulate the economy. So you can see that in 2008, despite the Federal Reserve was printing a huge amount of money, but the money multiplier effect is not being realized. Actually, it totally collapsed because the banks are now willing to lend the money out, and despite there's a huge expansionary monetary policy going on in 2008, the banks are undercapitalized. They're being very conservative, and also because of recession, they're afraid of going bankrupt. So although they were able to have a lot of liquidity, they're not willing to inject that into the real economy. So that's what happened in 2008. You can see that this ratio has been declining until 2014, where we actually have a recovery. The stock market, everything has been going up since then. Right, and what's interesting is that during this tells me that since February 2020, you can see that the ratio is actually going up, which indicates the financial institutions during this recession is actually much healthier than where they were in 2008. They were very weak in 2008. Their balance sheets total garbage, and they're not going to lend in 2008. But now, if you look at this during this recession, the financial institutions are actually willing to lend. So all the multiplier is actually going up. So it just tells me that the credit is actually being flowing into the economy, or flowing into the investors, and that is good for the stock market. Okay. Unemployment obviously has spiked, but one thing we really have to take into account that we have to pay attention is that this unemployment data, I don't really look at it because this is a lagging indicator, right? So you can see that almost always at the end of a recession, the unemployment peaks. You see that? So unemployment peaks start declining not before the end of recession, but after the end of recession. So if you're looking at unemployment data and looking for turning points, and use that as your guide to pick a bottom in the stock market, then you will be mistaken, because the stock market would bottom way before the unemployment data peaks. And this really just happened right now, right? The stock market maybe already have bottom in March, and unemployment data has recently peaked. So you don't want to trade the market using the unemployment data. You can see the unemployment data was 14, and now in May it's 13, so it has peaked, but it peaked after the bottom of the stock market, historically speaking, and that's almost always the case. So you don't want to use the unemployment data. This is a lagging indicator as your kind of when you're trying to understand the macroeconomic status of the economy. You don't want to use the status. It's pretty useless for trading and investing. PMI composite, you can see the PMI composite right now is still down. This is also another manufacturing composite index, where the PMI, the ISM, is the Institute of Supply Management. They do a monthly survey on all the companies. A lot of companies, they try to figure out and gauge what's the state of economy is. So when usually the rule of thumb is when this number is above the number 50, it usually means the manufacturing is doing well. When it's below 50, it means the economy is the manufacturing sector is doing kind of not good. And you can see that right now we are obviously below 50. We're 41, and we're obviously in recession just by looking at this data, right? You don't need some news channel or Federal Reserve chairman to tell you that we're in a recession. We're definitely in a recession just looking at these data. But are we coming out of recession? Yes, there are some signs that we're coming out of recession. For example, this one, the capacity utilization is actually not that bad, right? The production index seems to be bottom. I'm expecting this index that the next data point probably just going to reverse, and we are hitting some very extreme levels on these numbers. And that tells me that the economy is probably hitting close to the bottom from this pandemic, and this is healthy for the economy in the long run. We need these kind of recessions so that the economy can keep going. We need these recessions so that we can weed out weak businesses and restructuring these weak businesses, making the economy more efficient going forward. But one thing that we really have to understand is that the monetary policy is getting it's getting less effective since 1997, and I mean this as long as the velocity of money is declining, the government, the Federal Reserve has the inflation is not going to come back, right? I'm talking about real inflation, not asset price inflation. That means the Federal Reserve is very unlikely going to raise rates, which means the interest rate is going to be kept at a very low level, and that means the investor can borrow money at a very low cost. That also leads to asset price bubbles. So we really have to focus on putting our money into sound assets, because cash right now is a trash. That's all I want to say today, and hope you guys enjoy your Friday and also the weekend, and see you next time.